Bitcoin just dropped 40%. Fear index hit 8. ETF headlines say institutions are leaving, so you sold. Meanwhile, wallets holding over 1,000 Bitcoin just bought 53,000 coins, $4 billion. If whales are buying, who are they buying from? Tonight, we audit the structure behind the panic. I used to panic sell too. I'd watch the fear index drop below 20. I'd see headlines about outflows, and I'd think, if everyone's scared, I should be scared too. But the regime changed, because everyone isn't one group. There's retail, there's small whales, there's large whales, there's institutions, and they don't move together. The question I stopped asking was, is the market scared? The question I started asking was, who's scared and who's buying that fear? That's the shift. Let's look at the structure. February 2026. Bitcoin falls from 90,000 to 60,000, 40% drawdown. The fear and greed index hits 8. Extreme fear, lowest reading in over a year. Crypto Twitter says, bear market. Reddit says, it's over. ETF outflows hit $686 million in 2 days. The narrative is clear. Smart money is leaving. But on-chain data says something different. Wallets holding over 1,000 Bitcoin, what we call large whales, accumulated 170,000 Bitcoin since the start of 2026. Last week alone, they added 53,000 coins, $4 billion, the largest buying spree since November. Here's the divergence. While retail wallets holding less than 1 Bitcoin, saw net outflows, large whale wallets saw net inflows. The panic wasn't universal, it was directional. Retail sold, whales bought. Now, why does this happen? Because incentives are different. Retail trades on emotion. Fear index drops, they sell. Price pumps, they buy. Whales trade on structure. When fear index drops below 20, historically, that's been an accumulation zone, not a time to panic, a time to position. The whale doesn't care if you're scared. The whale needs you to be scared because your fear creates their entry price. You're not competing with the whale. You're filling their order. So what does this mean for you? If you're holding Bitcoin because you believe in long-term adoption, but you sold last week because the fear index said 8, you just financed someone else's long-term position. The whale didn't sell at 60,000. The whale bought at 60,000. Historically, extreme fear has been an accumulation zone, not a timing signal, a positioning zone. The whale holds the position you just gave up. This isn't about bullish or bearish. This is about who has the longer time horizon. Retail trades weeks, whale's position quarters. The incentive gap is the mechanism. If you want to track this yourself, watch 2 things. 1, whale wallet balances. Glassnode tracks wallets holding over 1,000 Bitcoin. If that balance is rising, while price is falling, accumulation is happening. 2, fear index versus price 30 days later. Historically, when fear index drops below 20, Bitcoin is higher 30 days later. Not a guarantee, a probability. If fear index is at 8 and whale wallets are accumulating, the structure suggests retail is exiting and whales are absorbing. That's the filter. This isn't a prediction. This is a structural audit. The whale bought $4 billion, while the fear index said 8. Retail sold. The divergence is on-chain. The incentive gap is clear. Decode motive, or become liquidity.